Okay, so today we're going through February-March 2020, question paper 12. We'll start at the bottom. A country changes to a policy of self-sufficiency in agriculture. What is that? That's subsistence farming instead of relying on world supplies. What is likely to happen as a result? Okay, so more food will be imported. That will be wrong, because they'll be making the food for themselves, they just won't be selling it. More farmers will be unemployed. That would also be wrong. Okay, because the farmers will just be working for themselves instead of working for others. So it doesn't mean that there'll be more unemployment created, because what's likely to happen is the supply of goods that are sold on the domestic market and the supply of goods that are exported will likely reduce. So there may be less jobs available, but they're unlikely to be less employed. So correct answer here is A, and why is that? So if you think about it, if people are having self-sufficiency, they're only making for themselves, and they're not selling it either domestically or exporting it. So what's likely to happen is that the supply that's being sold to the domestic market may reduce. And if you think about your supply curve shifting to the left, what will that do? It will reduce the quantity, and it will also increase the price. And if you think about it, it makes sense, because if there's less being supplied, the price of it will increase, and at the same time the quantity that's being both demanded and sold will decrease, as there will be a lot more people who are making the agricultural products just for themselves. And farm output will fall is also wrong. The output may stay the same, it's just that the output may not be sold. Okay, 29. The table shows a selection of economic data for a country. What is the current account balance of the country? So remember, we've got to take our trade balance in goods, trade balance in services, and add our primary income and secondary income. So if we go through these, primary income minus secondary income, that gives us a net figure of plus 500. Now we take away our goods, so our exports from our imports. 1000 minus 2000 is minus 1000. And services, exports minus imports, also 800 minus 200 is a figure of plus 600. Okay, so all we have to do then is add these up. 605,000 is 1,100 minus 1,000 gives us a current account balance of 100 million surplus. Okay, question 28. What would increase the demand for a country's currency on the foreign exchange market? So in the other videos, what we've given you is the really good mind map of the reasons why demand and supply would change on the foreign exchange market. Okay, now in this case the correct answer will be C. And why is that? Because what's going to happen is, as we're exporting, more of our currency is going to be traded as we are selling more products from our country. There's going to be more people who are changing their currency into our currency to pay for our exports. So that obviously means that imports would have the opposite effect. Right? Decreasing the rate of interest would also have the opposite effect, because people would be moving their money out of our bank accounts and changing it to other currencies to put it into other countries where they can get higher interest rates. And the same with a decrease in inward investment. We would have less multinational companies from other countries wanting to exchange into our currency for investment or creating a firm in our country. Okay, what is the most likely effect of a decrease in tariffs? So remember that tariffs are taxes, okay, and they're taxes on imports. So basically what we're saying is that we're decreasing the taxes on imports that we have. Okay, and what's the most likely effect of that? So, would it be increased inflation rates? No. Might actually reduce inflation because we can buy imports from other countries cheaper than we could before. Will it result in increased revenue of domestic firms? Definitely not. What it's going to do is it's going to create more competition for those domestic firms, because they now have to face the threat of having the imports coming in cheaper. Therefore, it's also not going to increase government revenue, it's going to decrease government revenue because they're reducing the taxes, so there will be less taxes paid to the government. But it will increase consumer choice because they will have a wider availability of options on imports. Okay, if the import prices come down, it means that it's now easier for us to import, so we get a wider choice of products. Question 26. What combination of changes is most likely to result in a fall in living standards? Okay, in a country. So, what we need to think about is what these three measure here, right? For GDP, we're looking for a decrease in GDP. So we're going to be looking for a fall in GDP. Why is that? Because GDP, if I just bring the arrow over here, like we've said on numerous occasions before, is linked to national income, employment, and living standards. And what we know is that when GDP goes down, national income goes down, employment goes down, and living standards also go down. Whereas inflation, we might expect that to go up. Okay, why would we expect inflation to go up for living standards? That's because inflation is the price of goods and services. So living standards are more likely to go down if everything is getting more expensive in a country. And finally, we would expect the population also to go up. And again, why is that? If we've got less goods and services being made and a higher population, then the problem of scarcity exists to a greater extent than it did before. So basically we'll have less goods and services available per person to purchase, which means that living standards will decrease. So if we just match them up to the direction that we can see here, we can see that we should be left with B. Okay, question 25. The Human Development Index ranks human development in countries from 0 to 1, which is the highest. What does HDI not take into account? So, estimation of life expectancy at birth. If you go and look at your HDI, included in your poverty section, notes and slides are available in OneDrive. You'll see that it does include life expectancy at birth. It does include the number of years of schooling. And it does include the standard of living linked to income per head, because that is literally what it measures. But it does not include regional inequalities of investment in human capital. So what do we mean by that? Basically we mean that if you think about China, for example, we might have a lot of money spent on education in Beijing, right? So the schools in Beijing might be very good, but the schools out in the countryside might have a very poor quality of education because they might have less investment available to them. Okay, and it doesn't measure that. It doesn't measure the difference between different areas, but it does measure the whole standard of living for the country. Okay, question 24. A country has a declining population. It also has a changing population structure in which the size of the 15 to 64 age group is becoming smaller. How could it immediately reduce labour supply shortages? Okay, lowering taxes and increasing basic wage rates. That will help to reduce labour supply shortages, but that's going to take a long time. So we're just going to say here, for argument's sake, long run, right? Invest in more technological research. Again, that might allow us to move our AS to the right, but that's also going to be long run. It takes a long time to research the technology and then to implement the technology. And again, encourages increases in family size. That's another long run effect. May help us to reduce the labour supply shortages in the future, but it's going to take 20 years for those new babies to enter the workforce. But if we allow, or if we attract 15 to 64-year-olds from other countries to come work in our country, it will immediately reduce those labour supply shortages. So it'll be a short run effect. And then we can use all the other policies to safeguard the labour supply shortages in the future. Okay, an increase in which of the following is least likely to cause inflation? Okay, let's start at the bottom. Wages can cause inflation. We call that type of inflation cost push inflation, and it's where AS moves to the left due to an increase in the cost of production. Okay. An increase in government spending. What's that going to do? Consumer spending. Consumer spending, also known as C, is a component of AD. Okay, that's going to move AD to the right. And what will that cause? That will cause demand pull inflation. Now it's the same thing with increase in government spending. G is also a component of AD. Increased government spending, AD to the right, and demand pull inflation. But if we increase income tax, that is a contractionary fiscal policy, and that's designed to move AD to the left. It puts less money in people's pockets, which means that they spend less money and they borrow less money because they're paying more tax. Okay, 22, very easy. A person receives annual interest of 4% on their savings. Inflation is 5% per annum. What is the approximate change? So we just need to take away the interest they're earning from inflation, right? So very simple. 4 minus 5. What does that give us? It gives us a net change of minus 1%. So the real value of their savings is going down by 1% due to the fact that inflation is higher than the interest they're receiving. Okay, 21, also very short. What is defined as a reduction in GDP for more than 2 consecutive quarters? That's defined as a recession. Okay. Deflation is a decrease in the price level. Falling wages are just wages going down, and rising unemployment, more people are not working. So you just got to know your definition for a recession there. Question 20 has come up in previous past papers before. We're asked to calculate the unemployment rate. Okay, so what we need to do is we basically need to understand the information we use to calculate it. We don't include, or we don't need, the full population size, because that's going to include children and elderly people who are not part of the labour force. We also don't need the number of full-time students. They're not part of the labour force because they're not actively looking to work. So very simply, how we calculate it is labour force minus the number of employed. So 1.2 million minus 900k is going to give us 300,000, and that means that 300,000 people are unemployed. So to calculate the unemployment rate, we need to take the number of people unemployed divided by the labour force size. So 300,000 divided by 1.2 million will give us 25%. Okay, in the past, governments have adopted policies to try and end a recession in their country and increase economic growth. What combination of policies is most likely to achieve this? So looking at A to D, we're talking about fiscal policy here. Okay, and we're saying we're trying to increase economic growth, so we must be trying to move AD to the right. What's our tools for expansionary fiscal policy to move AD to the right? That would be lower taxes, and it would be government spending goes up. Okay, remember our components of AD, C plus I plus G plus X minus M. Okay, so if we think about it, if taxes are lower, people will have more money in their pockets, so consumer expenditure and investment will increase. And if government spending goes up, government spending is a component of AD2, that will also increase. So we just match it up here and it looks like it's B, lower taxes and increased government spending. Okay, question 18. Why does more emphasis on education and training lead to an increase in national output? Okay. It reduces the power of trade unions, that's wrong. Education and training does not have an effect on trade unions. It reduces demand for higher pay, that's also obviously wrong. If people are more skilled at their jobs and they're more productive, they're more likely to want higher wages. It lowers the inputs of capital investment. Again, it doesn't have an effect on that. Education training for workers doesn't have an effect on how much capital investment we need to put in, especially if we're in an industry that we may still be capital intensive. But it does improve the productivity of the labour force. So improving people's skills is going to make them be better at their jobs and produce more. Okay, question 17. What is a monetary policy? Monetary policy is increasing interest rates. If you forgot your monetary policies, 4 components to it. There's interest rates, there's exchange rates, there's money supply, and there's credit regulations. Okay, so we can see that B, that's a fiscal policy, it's not a monetary policy. We just discussed that in question 19, I think it was. Reducing the power of trade unions, that's not monetary policy. And selling state-owned enterprises, that's also not monetary policy. Those ones could be supply-side policies designed to influence aggregate supply, not aggregate demand. Remember that monetary policy and fiscal, they're both designed to influence AD. Again, that was discussed in question 19 below. Okay, what is most likely to cause a more even distribution of income? So basically, what's more likely to move money from high income people to low income people? So, an increase in indirect taxation is not. Indirect taxes are taxes on goods and services. So if we increase our indirect taxes, everybody's going to have to pay the same amount. So it means that low income people will still have to pay the same amount for their goods and services. The same tax, as somebody who's earning a high income. Inflation is obviously not going to help us distribute income because everything is becoming more expensive. An increase in managers' salaries is not going to help us distribute income because that will be the high income earners who are getting more money. The low income earners may still be earning the same money. But if we have an increase in progressive taxation, that might help us to allow us to distribute income more evenly. As progressive tax, remember, is the more money you earn, the higher the percentage of tax that you pay. And the lower income you earn, the less tax as a percentage that you pay. So you get to keep more of your gross salary. Okay, question 15. A mining company bought another mining company. How may this integration be described? Okay, this would be described as a horizontal merger. I think about it this way, horizontal line, right? Here's the mining company number 1. Here's the mining company number 2. Why do we say it's horizontal? Because they're not moving up or down the supply chain. So vertical, for example, right? This might be the retailer, okay, who's selling the products. This might be the manufacturer and the mining company in this case. And then this might be the raw materials at the start, right? So vertical is moving up or down the secondary, primary, or tertiary sectors, right? Or the supply chain. Horizontal is moving along with the same company in the same industry. Okay, question 14. In some industries, a monopoly controls output and prices. What is the most likely effect of this on consumers? So this is very easy. A monopoly definitely does not result in more choice. Why? Because there's only one seller in the market. So one seller is definitely not going to give us more choice than if we had a competitive market, for example. Higher taxes. That doesn't have, a monopoly or not, doesn't have an effect on the taxes that consumers are going to pay. Higher profits is an effect for the company or for the firm. It's not an impact on consumers. But if we only have one company in a whole industry, it's likely that they're going to charge higher prices because they don't have any competition. So remember, in competitive markets, more choice creates more competition, creates lower prices. In a monopoly, less choice creates less competition, creates higher prices. Okay, question 13. When is profit maximization achieved? So, profit maximization is very simple. It means when are we making the most profit? And when our average fixed cost is at a minimum, that's not profit maximization because we don't know how much we're making or how much we're selling. We only know our average fixed cost is low. When average revenue is at a maximum, that's also not going to allow for profit maximization because our costs might be very high. When a firm produces the largest output it can with the resources that are available, that just means that we're being efficient. But again, it doesn't mean that we're selling it, and it also doesn't tell us anything about our cost. So profit maximization, or when we're making the most profit, would be when we have the biggest gap between our total sales, our total revenue, and the total cost of making the products, right? Profit is the gap between total revenue and total cost. And the bigger the gap, the more profit we're making. Okay, question 12. The table shows the costs of a firm. What is the average total cost if the firm produces 20 goods? Okay, first thing, our fixed cost is going to stay the same, right? So the first thing we need to do is we need to calculate our total cost. So 20 multiplied by 2, that's going to give us our total variable cost, which is 40. And our total variable cost plus our total fixed costs, which you know stay the same, means that our total cost is going to be 80. We're asked for our average total cost, and to get our average total cost we have to take our total cost divided by our output. So it's like, how much is it costing us per unit to make this good or this service? So we know our total cost is 80 and our output is 20. So if we divide them, we'll be left with an average total cost of $4. Okay, banks decrease interest rates. What is the likely effect of this on borrowing and saving? Okay, so remember that when interest rates go down, that means that if you put your money in the bank is going to be paying you back less money. But if you want to borrow money from a bank, it's going to be easier to borrow because you have to pay back less money. Therefore, what's going to happen with borrowing? Borrowing is going to go up, and spending will go up, and savings will come down. So again, we just match that up. We should see, oh sorry, I clicked the wrong one there. We should see it's C. Borrowing up, saving down. Which statement explains why the pay of doctors is usually higher than the pay of hospital cleaners? Okay. Correct answer here is A. Doctors have a higher opportunity cost in qualifying, so I'll explain what that means. Basically, if you want to become a cleaner, you don't really need any qualifications. You can just go and become a cleaner. But if you want to become a doctor, it takes a lot of money to qualify, and it can take, depending on which country you're in, it can take 7 to 10 years to qualify, which is obviously a huge opportunity cost because you're giving up earning a salary for those 7 to 10 years, and you're giving up the leisure time from all the study that you've had. Therefore, it's harder to become a doctor, which means that it's something that they will get paid more to do. The harder the job is, the more people get paid. So all the others wouldn't apply. The belonging to trade unions doesn't affect their pay. Doctors have more elastic supply. Again, not true. And hospital cleaners have a more inelastic demand. Again, unlikely to be true. So it's because of the fact that they have to take such a long time and spend a lot of money to qualify, that means they get paid more. Okay, what is the most important characteristic of money? So at the time I'm recording this, we've just gone through money and banking in class, right? And we had 4 functions and 4 characteristics. And what we said, or what I told you guys in class, is that, if I just give you the functions first, the most important function of money is the medium of exchange. And that's number 1 in our slides, right? So I said I've put them in order. Therefore, the first characteristic of money that we have in our slides is also the most important, and that is general acceptability. Okay? It has to be able to be acceptable as a term of payment. So the value is not affected, the portability is not affected, it's readily available, it's not affected. Most important characteristic is generally acceptable. Remember our other characteristics: recognizable, durable, and homogeneous. Okay, question 8. What is a trade union? Is it a business organization in which workers share ownership? No. Okay, that would be a partnership. An area where there's no barriers to trade? No. That's called free trade. It's an agreement between countries where they can import and export freely. Is it an organization of employers from an industry? No. Trade union involves workers, not employers. They bargain with the employers, but it's an organization of workers that will represent their best interests. So they'll try and get better health and safety conditions for their workers, and they'll try and get better pay for them too. Okay, what is not held constant when constructing the supply curve of a firm? So basically this is it's a difficult enough question for IG. You see it in AS more often really. Essentially they're asking us about ceteris paribus, right? Ceteris paribus states that it's a model that allows us to show the effects of one change at a time, normally in the price of the good, assuming that all the other factors remain constant, right? So just to give you a brief example here, if I draw demand and a supply curve, and we have an initial price, if the price of the good increases, okay, I'm modeling this change, so I'm showing the excess supply here, assuming that all of the factors that shift supply and all of the factors that shift demand have remained the same or haven't changed. Okay, so that's the idea of ceteris paribus. So if we match that up here, all the thing that's not held constant is the price of the good. That can change. All of the factors that shift demand and supply, they will remain constant. So that would be A, indirect taxes and subsidies affect supply. Level of technology is also a factor that can shift supply. And the price of the factors of production paid for the firm is also held constant. We're only considering the price of the good, not the price of the factors of production. In 2018, now again, I've seen this question on numerous papers, so the further you go back, the more you start to see they repeat themselves, and every 3 or 4 years they'll ask the same question. So the likelihood is, if you get through my videos and you get to 2021, 2020, 2019, you'll probably see some of the same questions again in 2025, which is when you guys will take the exam. So in 2018, the UK introduced a tax on the production of sugary drinks. How would this affect the market for sugary drinks? Okay, so we'll just draw it. Okay, so when we have a tax, remember, what does a tax do? That makes the product more expensive and it increases their cost of production, right? So the supply curve is going to shift to the left. It's going to increase the price of the product, which we can see on our curve, and it's going to reduce the quantity. So what's happened? We can see here we start at this point, and this is our new equilibrium after the tax is implemented. It has moved to the left on the demand curve, and we remember that when we move to the left on the demand curve, that is a contraction, right? So it should be contraction in demand and shift to the left. Okay, question 5. What necessarily describes the market system? Okay. Well, remember, a market system, no government involvement. The price mechanism or the market mechanism is used to allocate resources. Okay, so an economy with both a private and public sector, that's incorrect. That would be a mixed economy. No public sector and market system. Limited resources but unlimited wants. Okay, yes, that's the basic economic problem, but that exists no matter what type of system we have. It doesn't necessarily only describe the market system. Resources are allocated through demand and supply. That is correct, because what is it that allocates them? It's the price mechanism. So that works to automatically allocate the resources. And when all resources are used to produce consumer goods, no, incorrect. They will still make some capital goods. The likelihood is they might just make less capital goods than if they were in a mixed system, for example, where governments can incentivize them to make capital goods for long-term production capabilities. Okay, a country experiences a long strike by railway workers. What would be the macroeconomic impact of such a strike? Okay, so this one should be fairly straightforward. National output would fall. Why? Because national output, or GDP, that's a macroeconomic concept, right? Some of these other options here may happen, but they're not macroeconomic concepts, that they might be micro. So railway workers would lose income. That's true, but it's a microeconomic concept. Demand for taxis would rise, and the profits for railway operators would fall. They'll all be true. They're all effects of a strike, but they're all microeconomic concepts because they're all studying the behavior of individuals, firms, or individual markets or households, right? A is the only one that would affect the whole economy, so it would be a macro impact. Okay, question 3. I'm sure if you watch the videos you've seen this question has come up before. 2 or 3 different occasions, right? And every year, even though it comes up, students still get it wrong. So, we're asked to calculate the opportunity cost for only using it from farming. So basically we have to take what would we have got from using it for shale oil extraction, what would we have got from farming, and then we'll calculate the loss that we've had. So, in this case here, if the land is used for shale oil extraction, it would yield an income after tax of 40 billion, okay? So we'll just put it like this. We'll go shale oil, and that's 40 plus 10 billion. Because we're told here at the bottom, 10 billion in taxes from shale oil extraction, that's what the government would receive. Okay, so for farming, it would be income after tax of 10 billion plus 5 billion they would receive from taxes. So what are we left with? We're left with, if we had went with the shale oiling, we would have got 50. If we had gone with the farming, we would have got 15. So what's the opportunity cost of using this option that gives us 15? It's the 35 billion we've lost out on. Okay, 15 billion minus 50, we've had a net loss or net opportunity cost of essentially minus 35 billion, right? Because that's the money we've lost. Diagram shows the production possibility curve of a country producing at point T. A country has an aging population and decides to allocate more resources to the production of health services. What movement shows this change in resource allocation? Okay, so we want to move more towards health services. Remember, resource allocation or reallocation is always a movement along the curve. Okay, because we're still maximizing our use of current resources. So S, for example, is not going to be relevant here because that's inefficient use of resources. and U is not going to be relevant because it's scarce. We may want to make this much, but we don't have the resources available to do it. So then we just simply need to show our change between non-health and health. So T to S does not apply because S is inefficient, and we know that resource allocation is always a movement along the curve. T to U again doesn't apply. T to V, what happens there? We look here, we're making less health services. When we move to V, then we're making more health services and less non-health services. So that's going to be our correct answer. T to W would be the opposite effect. We're moving from health services to non-health services. And that's not what the question asks us. Okay, in question 1, this part is easy. We've gone through this in class. Money is not a factor of production. You may say capital, but capital is equipment, machinery, etc. It's not physical cash. Okay? An office would be land, a photocopier would be capital, and a secretary would be labor. Okay? And remember, the owner of a business would be enterprise. Physical cash is not a factor of production.